Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, stocks on the brink of a bull market. Can the rally continue with big names like Jamie Dimon warning of growing risks? We're going to discuss all of that. Plus, Home Depot saying it won't raise prices due to tariffs. But how will that impact the home improvement company's bottom line? We'll have full coverage for you ahead. And crypto's big win in Washington. We'll break down what stablecoin legislation could mean for the digital asset space and whether it can reignite a rally in crypto. Half an hour into the start of U.S. trading, let's get a check for you of the markets. Taking a look at major averages here, you're looking at declines across the S&P, the NASDAQ, and the Dow. You've got your S&P off just about 0.4%, your tech-heavy NASDAQ off just about 0.6%. If we take a look at the sector action in the S&P, really the only ones holding on to gains right now are utilities, consumer staples, and healthcare just a bit above the flat line, but tech, the biggest laggard on your S&P right now. But let's flip the board over to the bond market, which has become a bit of a headwind for stocks. You've got your 10-year yield up 4 basis points, holding above that 4.5% level. You've got your 30-year just below that 5% key psychological level that it hit early this week for the first time since 2023. Will the bond market start to look a little attractive as a safe haven area for investors, or will all the volatility in bonds make investors continue to look elsewhere for safety? That's something we'll continue to talk about. But finally, let's take a look at Bitcoin, holding still below that 105,000 level, but up on the day about 1%. I want to bring in my co-host for the hour. We've got Chris Versace back in the studio with us. He is Tematica Research's Chief Investment Officer. Chris, great to have you. Appreciate you coming back in. Talk to me about where you're at with the market right now, because we're seeing, obviously there was so much volatility, and then we had a record win back to the upside for retail investors who bought the dip. Should investors continue to buy the dip in this moment? So
let me tell you what we did this morning at the Street Pro portfolio. We actually trimmed back our position in 6 stocks, all of which have had monster gains since the April lows. And we just take a look at the market now. S&P 500 on the cusp of being overbought technically with an RSI level. NASDAQ in that territory. We have some concerns. We get some Fed officials saying, no rate cuts maybe till September. Your comments about the bond market. So we think the market's a little extended here, hence the move to lock in some gains. And when you say we sold 6 stocks this morning, how are you picking those names? Faded. To be clear, yeah. So we trimmed back, locked in a nice piece of gains. We didn't sell out because we still like the positions long term. But these have either had demonstrative runs, right, since the April low, so up 20, 30%, something like that. Yeah. They could also be a little in overbought territory as well. What are some of those names? Well, I'll give you some of them. So Axon Enterprises, which has been a champ for the portfolio. We also took advantage of the big move in Microsoft and ServiceNow. Yeah, and ServiceNow, another one that was such a rip post-earnings, but then there were questions about whether it was really that good under the hood. Did they benefit from currency tailwinds, for example? Right. How do you think about that throughout this earnings cycle? So, there's a lot of things that are kind of going on, right? For me, the bellwether, and I think we talked about this last time I was here, margins. What is the prospect for margins? But with regarding ServiceNow, we continue to get a lot of favorable data points about AI adoption, not just in the enterprise, but elsewhere. Yeah. So I still think, not to be a parrot like others, but are we still in the relatively early inning stages? I think we are. And for me, that keeps me bullish on ServiceNow long term. And since you mentioned margins, I want to go to Home Depot because they kept their full year guidance. But they say they're not going to raise prices due to tariffs. When you're an investor, how do you hear that? Do you want to hear companies say we will raise prices to protect margins, or are you okay with them eating it to avoid any bigger risks in terms of administration pushback? So if I'm an investor, I want the stock price to go higher. Ultimately means they have to continue to grow their earnings, grow their profit base. So if there's a challenge to that, then I have to be a little concerned. So I was very surprised that Home Depot said what they said, especially coming off of what Walmart said last week. And I think we're going to hear other retailers say this week, next week, that they are going to have to push through incremental price increases. But here's the thing, Madison. What happens if we get a trade deal or a multiple trade deals? Those tariffs come down. Do companies bring their prices down? Probably not, which means, right, which means 2 quarters, 3 quarters, whatever it is down the line, we could see some nice margin improvement.
Right. Okay. I like the bullish optimism there, Chris. Thank you so much. You're going to have all that optimism for us throughout the hour, I'm sure, so stick around. Really appreciate it. Let's go to Washington, though. President Donald Trump is meeting with House Republicans on Capitol Hill as the party remains divided on several key issues in the budget bill. The president briefly stopping to speak to the press alongside House Speaker Mike Johnson ahead of these talks. Let's listen in.
This is bigger than any Ronald Reagan tax cut. It's even bigger than the tax cut that I gave, because as you know, that's being extended and increased. So this is the biggest tax cut in the history of our country, or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast.
Joining us now on this, we've got Monica Guerra, Morgan Stanley's Wealth Management Head of U.S. Policy. Chris Versace still in the studio to join the conversation as well. Monica, a lot to talk about with this tax bill. Obviously, and we talked about this just before, it's going to happen. But the question is, what does it look like? What are the key sticking points? What do you think is the biggest item within the tax bill that's up for debate right now?
Right now, as far as getting the full support, it is really about SALT. And can they actually come together as a coalition? You have the fiscal hawks versus the SALT Republicans, as sort of they've been branded. And can they get to that deal? That's really where you're going to get the critical mass to get to 51% to get this bill through, because you just need that simple majority to get a budget reconciliation bill through. Now, there's one other sort of area that I think that people aren't paying enough attention to, and that is on the spending cut side of this. And we do think that there are going to be notable cuts to Medicaid. This is something that has been highlighted. But the risk to states and non-for-profit hospitals, when we're thinking about the municipal bond, credit quality, that could have some significant pressure. So that's something we're also watching carefully, especially as we're sort of sorting through the fits and starts around treasuries in the last 48 hours.
Yeah, a lot to talk about there too. But one of the things that has been a little bit mixed when I talk to investors is how they view these tax cuts, whether they view them as a huge positive catalyst for the market or just a deletion of headwinds. Where do you see it? Like, are these tax cuts just an extension, or are they bigger tax cuts than what we saw in 2017? How does it net out for investors?
Yeah, for me, I think that this is just an extension of status quo. Maybe you get a little bit of lift on the margin, but if you're even looking at the corporate tax framework, we're not getting that decrease in top-line corporate income tax that was promised on the campaign trail. Yeah. That isn't on the table. That, I would think, would maybe give the biggest oomph on a short-term tailwind basis. But the rest of this is just an extension of status quo, and maybe what you're getting is more of a relief for the consumer in relationship to that tariff call. So for us, this could, I would say a nice to have, but it isn't going to be the big sort of relief package that we're expecting for markets.
Can you operationalize that relief for me for consumers? Like, how big is that relief going to be?
As far as how big it is, I don't have those numbers, because if you're thinking about it's changing every second. And if we're looking at, especially, say, a SALT relief piece, maybe that if we're thinking about consumer strength, you're getting more movement in the housing market, right? You could have people leveraging up in mortgages. That is a wealth builder. So when we're thinking about from the economics perspective, a sort of balancing around potential, tariff risk, that could be something that could at least be in the positive checkbox. So we're going to see how that goes. But other areas where you could see a little bit of give back is that bonus for seniors, and that's always a benefit. But the problem there, if we're thinking about the consumer side, is that typically those types of things for seniors go into savings, right, until they're ready to have that drawdown. So it is a little bit of a delay. It's not a direct economic multiplier or spending multiplier.
So your comment on the extension for corporate taxes not really having a lot of extra oomph, right? So when we look out at 2026, maybe even 2027 earnings expectations, you don't really see a lot of incremental positive coming out of this deal, assuming we get one.
Yeah, not related to taxes at this time. We'll see. We are going to have negotiations well into the evening and early morning hours of Wednesday, and we'll have a more clear path forward from there as they head towards Memorial Day. When we're thinking about where the gains are for corporates, It really is a 2026, 2027 potential for fiscal spending and which companies are beneficiaries of the new budget cycle. So 2026, we already know there's likely to be a 13% or more increase to defense spending, for example. And I think AI, data centers, infrastructure, all the second derivative beneficiaries are going to be a part of that call. And so for us, it's not really about the tax bill that's going to get us there. It's going to be about this sort of pro-growth spending piece of the equation.
On that front, though, Trump has talked about kind of dialing back the CHIPS Act effort, right, that we saw under Biden. How do you see him fostering capacity coming into the U.S.? Because we clearly need to have that.
So I think what's interesting about that is that my feeling is that it could be a talking point. I have strongly had that reinforced by comments from Guerra and Lighthizer, who have said that they're actually interested in doing more subsidies. Potential for more subsidies, not only for semis and chips, but also shipbuilding and pharma. So they're looking at sort of I would say, choosing at the buffet, right, of different policy options and not necessarily locking into traditional GOP or traditional Democratic playbook. And so this is going to be really interesting for how 2026 plays out.
I want to end on how you're feeling about these tariff negotiations, because there seems to be a lot of optimism when you look at the tape of the markets, but that hasn't necessarily borne out in terms of actual deals. How should investors be thinking about where these tariff negotiations are heading?
So when I'm thinking about the negotiations, I'm looking at two people, Trump and Besant. Can't really listen to anyone else, right? They are the ones that are going to be the standard bearer. And I think that Besant has been giving us really great signals as far as their progress. It doesn't necessarily mean that that's where we're going to land. So if he says 7 to 10 days, 14 days, whatever number he drops, I think that that's a good benchmark to look towards. But again, it doesn't get us that final place because we need to hear from the president directly. So I do think that they're in progress. They've communicated that. The one, I would say, brilliant thing about this administration is they tell us everything that they're doing. And so while it could create some interim market volatility in response, we have a playbook for the near term. And so for us, when we're thinking about new deals, we got to look to that 7 to 10 day window and then, plan ahead from there.
Monica, really appreciate your insights always. Thank you so much.
Right,
Thank you for joining us. Coming up, we're going to break down Treasury auctions. We're going to explain how they work, what they mean for stocks, and what you need to know about those auctions and demand at them. We're going to have that for you next on Catalysts.
On Monday, the U.S. 30-year Treasury yield, that's the interest rate demanded for 30-year debt issued by Uncle Sam, it punched north of 5% for the first time in years. And investors are now laser focused on bond auctions as a key to determining the next move for stocks. I'm Jared Blikre, host of Stocks in Translation. First off, what is a Treasury auction? It is an event where the U.S. government sells bonds and bills, IOUs basically, to raise cash for federal spending at an interest rate determined by investor demand. So, Treasury auctions are a regular event. Treasury bills, which mature in a year or less, they're auctioned weekly. Longer-term notes and bonds are auctioned monthly. Key longer-term auctions like the 3, 10, and 30-year, they are happening next week. And that's what traders are watching closest to gauge investor appetite. And keep this in mind, this isn't even the full list. We got tips, we got floating rate notes, and other bills that happen separately. So who's buying this? Indirect bidders. These are mostly foreign central banks and big overseas investors. They are a critical measure of global confidence in the U.S. debt market. Direct bidders include U.S.-based fund managers and everyday investors using Treasury Direct, although that's actually a smaller slice, typically under 1%. Finally, we have primary dealers. Those are the big banks required to buy whatever remains, and they act as a backstop, and they are closely linked with Federal Reserve operations. And here's why the bond auction breakdown matters. Foreign participation in the key 30-year auction is sliding, hovering near 60% lately. It's down from over 70% recently. And this downward drift, it signals cautious sentiment around the world. Lower foreign demand, that means higher borrowing costs and rising pressure on markets. Auction results, they send immediate signals. Low demand, prices fall, yields spike, which means caution, with stocks often responding negatively. High demand, prices rise, yields dip, and this can signal confidence, supporting stocks. And remember, bond prices and yields, they move in opposite directions. So each auction, it's a real-time risk gauge. And here's a big picture. Rising auction yields directly impact debt service costs, which are now surging towards record highs. This isn't abstract. Every dollar servicing debt is one less dollar for other critical spending, and this influences long-term economic health and also market stability. So, bottom line, Treasury auctions are not just about bonds, they are about confidence, costs, and markets, and that's why investors and traders, they can't afford to look away. All right, stay tuned for more episodes of Stocks in Translation, new episodes each Tuesday and Thursday, wherever you find your podcast. Back to you guys.
Jared, thank you so much, as always. Love that we're talking bond market auctions. Appreciate it. Taking a look at Home Depot shares, the company reporting mixed first quarter results. Stock is higher, though. Earnings per share coming in below expectations, but revenue topping estimates up more than 9% year over year. The home improvement chain reaffirming its full year guidance. Really critical, though. The company said it does not plan to raise prices amid the ongoing trade war. So how does that net out for investors? Joining me now, Michael Baker, D.A. Davidson Managing Director and Senior Research Analyst. Michael, great to have you on this morning. I got to start on the company looking to maintain prices. How can they do that and also maintain profit margins?
Well, they do have some offsets, and I think that's one of the keys to the story this morning. Things like lower shrink costs, better supply chain management, that is enabling them to offset some of the higher costs that they're paying from tariffs. They're also using what they call the portfolio effect. So in general, and on average, prices won't go up. But I do think there'll be some areas where you'll see price increases, some areas where you'll see price declines, such that the average basket doesn't necessarily go up, but they can manage tariffs that way by looking at different pricing for different products.
So when you look at the balance sheet, then I'm curious how you're thinking about things like inventory pull forward. If they are going to follow this sort of diffusion model when it comes to pricing, is that inventory pull forward potentially a risk to the balance sheet in quarters to come?
It doesn't really seem like they pulled forward too much inventory. Now, inventory was up year over year, but part of that is a function of the acquisition, the SRS acquisition that they made last year. And they've also seen a little bit better demand over the last few months. In fact, April in the U.S. was the second best comp month that they've had going back at least a year and a half. So the inventory, while it might look high on the balance sheet, up, I think it was 15% year over year. Again, a lot of that was not due to pull forward, but just due to other factors. The majority, again, that big acquisition that they made a year ago.
And my guest host, Chris Versace, has a question for you, Michael.
So, Michael, when you take a look at Home Depot's guidance and you kind of look at the soft housing market that we have right now, concerns about consumer spending, consumers kind of becoming increasingly selective, dialing back in certain areas, what's giving you comfort with Home Depot's outlook for the coming quarters?
Yeah, I think a lot of it, again, is the trend that we've seen the last few months. If you include the fourth quarter and now the first quarter in the U.S., so adjusting out currency, they've comped positively 2 quarters in a row. They've been negative going back to the post-COVID era when they lost a lot of sales because of the pull forward during COVID. So the last 2 quarters, positive comps in the U.S., and that included an acceleration within the first quarter. In other words, March and April were better than February, and some of that has continued into May. So we don't want to overstate it. They're certainly not comping at the level where they historically did in the 3 to 4% range, but they are flat to up slightly. In fact, maybe even 2% in April when you adjust for the Easter shift that they're closed on Easter, so that hurt April. And even with that, again, it was the second best month in about a year and a half. So they do have a little bit of momentum on the side, and that's what gives us comfort with the 1% comp for the year.
So tracking that momentum is going to be key for investors. What are some of the things that you'll be watching, in the next several weeks, several months throughout the summer to kind of get a feel that guidance is tracking?
Sure. Well, we have a number of leading indicators that we track on an inter-quarter basis and publish frequently. This is things like overall retail sales. We spend a lot of time looking at their vendors. A lot of their publicly traded vendors report a month before Home Depot does because they have a December year end, whereas Home Depot has a January year end. So we hear from Stanley, Black & Decker, Masco, et cetera. That gives us good insight. We do get weekly point of sales data. So there's a lot of stuff that we track and we publish on. And that really does help us get a sense as to whether they're tracking in line or not. And if we see things waver, we'll adjust accordingly.
And Michael, I also want to look ahead to some of the other retail earnings that we have coming up, particularly when it comes to a company like Costco. How are you thinking about that retailer in this moment?
Well, Costco is doing exceptionally well. We know that. Remember, Costco is the only retailer still that still gives us monthly comps. So we have a very good sense as to how they're comping into quarters. So when they report it, it's really about margins. But when we look at the monthly comps, they're just taking a lot of share. Really, all the clubs are doing well. Sam's Club within the Walmart report last week was very strong. BJ's has been taking market share. In fact, BJ's has been one of the best performing stocks in our space year to date. BJ's stock is up more than Costco's. But all three of them are doing very well. The club space in general, just taking market share in an environment where consumers are really focused on value.
And I guess I wonder if you can kind of put a bow on all of this for me here, especially as we head towards Target earnings. How are we going to see retailers sort of entering either the Walmart camp of admitting to raising prices versus the Home Depot camp of saying we're going to keep prices where they are? And what are the factors that you think different retailers are going to consider as they're deciding which camp to signal that they're going to be in to investors?
Well, it's very tricky, and you're right. To me, it's much more about signaling. I don't really think those two companies, Home Depot and Walmart, are doing things that much differently. It's just how it's articulated. I think Walmart wants to send a message perhaps to the administration that some prices will go up, and so try to help with the tariff negotiations, if you will, telling the administration that we really need some help on tariffs. But again, Walmart also will use a portfolio effect. In some areas, prices will go up, some they'll go down, and I think it'll be about neutral. But really, it's just about how much you want to sort of signal to the administration, and Home Depot just seems to be taking a more conservative approach to that. Walmart a little bit more aggressive. How other companies do it, Walmart really has the size, the scale, the credibility, whatever you want to call it, to really articulate that a little bit more effectively than I think some smaller retailers. That being said, smaller retailers, they might not have a choice. They might have to raise prices because they don't really have the offsets that the bigger retailers with scale have, i.e. pushing some of the tariffs back onto their suppliers.
And Michael, I want to end with something that Chris actually flagged to me on set earlier in some of his commentary, this idea that maybe these retailers will have a lift in the second half of this year if we do get these tariff negotiations. To what extent do you think investors are maybe underpricing a potential lift to retail stocks if we do start to see the tariff risk fade?
Sure. Right now we're pricing in a 30% tariff in China and 10% elsewhere, and I think that's a decent baseline. But if that 30% were to come down, you will see a margin benefit. You will see the retail stocks benefit. My guess is you'll see the entire market benefit. So I don't think that's priced in. I think what's priced in now, again, is that 30% China tariff. Anything better than that will, to me, absolutely be a positive, both for margins and stock prices.
We got to get a panel with you and Jamie Dimon so you can talk about who's right, the ones underpricing risks or overpricing them. Michael, thank you so much. Appreciate it.
Sure. Happy to do it.
We're going to have all your markets action ahead here on Yahoo Finance. Stick around. You're watching Catalysts. It's now time for some of today's trending tickers. We are watching Cattle, Tesla, and D-Wave. First up, CATL. Cattle is soaring in its Hong Kong trading debut. It's an EV battery maker. They're raising $4.6 billion in their IPO, making it the world's biggest listing so far this year. The Cattle supplies batteries to several automakers, including Tesla, Volkswagen, Ford, and Mercedes-Benz. Taking a look at huge gains off of this news of the potential IPO here. And Chris, it's really interesting when you think about a name like this. We were talking about how investors should be viewing international opportunities. Is a name like Cattle one that you would look at?
I would say conceptually it would be, right? It's an interesting derivative play on the EV market.
Yeah.
They sell predominantly in China, so I have some concerns about that just from an accounting perspective. But, if you're looking for a company that gives you broad-based exposure to the overall EV market, as I like to say, buy the bullets, not the guns, this is a nice way to do it.
And would you be comfortable looking in some of those Asian markets in particular where we don't have as much sort of transparency?
I would say that I'm not going to say. I'll tell you what I would do. I would stick to ADRs because of the accounting that we get and the timely financial reporting that we get.
Yeah, I think that's important just for like investor hygiene to keep that
100%.
in mind here. Let's move on though to Tesla. Elon Musk saying he's committed to being CEO for at least 5 years. He was speaking at the Qatar Economic Forum earlier today, talking about sales declines, pulling back on political spending, and his role moving forward. First CEO saying he would spend on another campaign if he saw an opportunity, but he doesn't see one at the current moment. The Tesla shares up about 0.8% right now. Chris, how do you think about Tesla?
I think it's a story that has to be figured out once again, and I think this is not surprising over the last couple of weeks, right? You know, if you go back to right after Inauguration Day, was Musk running Tesla? No, he was busy heading up Doge and doing all sorts of other things. And I think folks were looking for him to come back. I think the question is, does he still have it? Is he still the Musk that we know? Or are we going to get something else? So for me, it's a stock to watch.
Yeah, stock to watch, a stock that is down at the current moment 9% year to date. But finally here, let's look at D-Wave releasing its latest quantum computing system known as Advantage 2. It's the 6th generation of the system and is currently available through the company's cloud service. Plans to release physical machines from the company over the next couple of years. Those shares up 26%. I feel like every time I'm talking about D-Wave, it's either a massive move to the upside or the downside.
To me, the comment that you made of over the next few years, to me, this is very much a story stock. You know, folks, I can understand, want some angle in the next disruptive thing, the next new thing, and quantum computing could be it. But when you've got Google and Microsoft coming out saying, whoa, this is years away, I would rather wait for the tipping point when we actually see the market emerge, rather than, roll the dice and have some hopium in place.
Well, do you think that D-Wave benefits from a little bit of investor FOMO, the investors out there thinking, well, I missed the beginning of the AI wave and I don't want to miss it for quantum?
I think there is some of that because folks don't want to be left out. They are always looking, again, for that new thing. The question is, steak, sizzle, what do we have here?
Right, exactly. That is, of course, the million-dollar question when it comes to investing. Chris, thank you so much for your insights. For our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. On the other side of this break, our next guest saying now's the time to add dividend stocks to your portfolio. Get a little income generation. We'll bring you those picks when we come back. The S&P 500 on track to snap a 6-day long winning streak as fears creep in that recent investor confidence has been overblown. Forget buying the dip, though. Our next guest says it's time to de-risk and instead focus on quality dividend-paying stocks. Joining us to discuss whether this is the moment for dividends, you've got Max Wasserman, Miramar Capital co-founder and senior portfolio manager, and still with us for the conversation, Chris Versace. Max, it's great to have you on. I've been trying to talk dividends for about 6 weeks, so I really appreciate you being here. Talk to me about why dividends make sense for investors right now.
Sure. Well, I'll say they make sense all the time, but if you go back to the 1920s, they say about 40% of the total return of the S&P 500 has been dividends. And in certain 10-year decade cycles, it's more and sometimes it's less. But the bottom line is you're getting paid to wait. Nobody can time this market. It's up and down. And the cash flow is coming in every quarter from the dividends, and you get to reinvest it. So you can either take the money out or you can reinvest it the way you want to. And for people who live off income, a Treasury bond's giving, let's say, 4%, 3.5%. We look at a dividend growth portfolio, so we have about a 3% yield. So we're getting over 80%, which you can get in a Treasury, plus growth.
Yeah.
So for people who need cash flow, dividends are an excellent way. Also in terms of volatility, the market. If you go the first half of the year, the market's all over the place. Dividend stocks hold up better in times of, craziness, volatility. So we like it. And we think the investors are overlooking the basics of investing. They just want the hyper growth, but it can go away in a moment. But dividends are steady. And for somebody who wants to be a long-term investor, we think dividends are the best place for it.
Was that shade towards the big tech stocks that I picked up on?
We own some big tech stocks. We like them, but the valuations are out of control, right? 30, 40, 50 times earnings and some. And the market's overcrowded. Everybody buys the same 7. You're looking at those stocks. We have some of them, and they do pay dividends. Some of them pay dividends, and they're paying more as time goes on. But for valuation level, we just don't think it's worth the risk to keep buying them, right? Buy them judiciously, we like. But the rest of the market, right? The rest of the market looks relatively inexpensive compared to the NASDAQ. And we think if you can get 3-4% yields in growing areas, that's a great place for the investor to be.
So what are some of those areas that you think are most entertaining, let's say now, for investors?
Sure, nobody likes pharmaceuticals right now. Nobody. You can't give pharmaceutical stocks away. But companies like AbbVie that we have an investment in, it's paying you 3.5%, and they're growing the dividend 8% a year. Financials selectively, we own a company called CME, right? Chicago Mercantile Exchange. They pay about 4%. They give you a dividend of roughly about 2%, but they give you a fifth dividend at the end of the year, right? Especially pay out all the profits usually to the people. Those are good things. Industrial stocks are good. Energy, which nobody likes energy right now. They did about a quarter ago, and they're paying you 4, 5, 6%. So you do a mixture, and you even throw retail stocks in there, like the Home Depots of the world, which I know came out today, we like, and you look at those. If you put them together, you have a good dividend portfolio with growth. And that's the key. We're not buying utilities. We really don't own a utility in our portfolio. But we look at other areas of the market that are growing the dividends, paying higher cash flow.
So let me ask you this. So you're talking about yields, 3%, 6%. At what point do you use the dividend yield as a signal that something might be wrong? Is it 8%, 9%?
Oh, that's a great question. When we look at the dividend yield, we're looking at the payout ratio. Look at how much of the earnings are being paid out to cover that. And when a company is paying more than their earnings per share,
right,
that's a cause. Or if they're telling us to slow down in the dividend growth rate. So if you're starting to see a massive slowdown from a 10, 8, 5, 3, 2, there's something wrong with the cash flow. But it's a great valuation tool, right? The relative dividend yield to itself, right? What's its own payout ratio to the market, to the Treasury? We look at that compared to the Treasury. So we look at it all, but it's an excellent valuation tool. But the payout ratio to us is one of the key things. You have to watch how much earnings are coming in to how much you can pay out. And when a company starts getting 70, 80%, it requires a lot of attention.
Can we apply that payout ratio thinking then to some of those Mag 7 names as a framework for which ones are the best dividend payers? You've got 5 of the 7 paying dividends. Right. How do you use that framework to decide which ones are the best?
Well, the payout ratios, they don't look so much because they're usually 10, 20, and 30%. That gives me opportunity for expansion, though, in dividend payout. So that tells me when a company's doing 10, 20%, you can pay out more as time goes on. We look at cash flow growth, right? And return on equity, what are they doing? But the big 7 tech, it's all about their capital expenditures right now, right? Where are they going to pay out? Where are they going to reward? And they're doing buybacks. That to me is like oversimplification. All you do is just keep announcing you're going to buy more of your stock back. But in reality, they don't. They're just increasing how many they're going to buy. But if you look at the buyback announcements, they say I'm going to go from 5 to 10, but they're still at 5, right? So you have to look at what they're actually doing. So we look at the outstanding, shares going down,
right.
And a lot of them are just paying back their, options they gave to their holders, right? So we look at it that way. But there's a lot of value that can be made there. But 50, 40, 30 times earnings, we're saying you're not buying those for dividends. You're buying them for dividend growth. And it's a little bit different.
No, I see what you're saying. I am curious, too. I spoke with the CEO of Public yesterday, which is an investing platform, and he talked about how retail investors are obsessed with dividend-paying stocks and that there are all of these financial communities online that are talking about the importance of dividend-paying. Have you seen that activity and interest from retail in dividend-paying stocks?
It's interesting. Our clientele, we sort of have to convince them of the value of dividends. Because everybody on TV is everybody talking about growth, hyper growth, right? The Bitcoins, you buy that. So we try to educate our clients the value of dividends. Yes, it's good, but don't chase yield. There's a lot of great Dow stocks there used to be that cut their dividends, right? Are no longer paying them. Great companies such as Boeing, Disney, they had to cut those dividends. So you have to watch what you're investing in. Do they have growth in earnings? Do they have growth in cash flow? Cash flow, we spend a lot of time with fundamentals. Right? Yeah. So we're looking at that. So for the investor, I would say, yes, dividends are a very big component, but get a mixture in a portfolio. You want dividend growth, you want a little bit higher yield, but if you're getting something 7, 8%, there's a reason. Right. It's usually the prices come down or they're getting ready to do something. Don't chase high yield. Even 2% and 1.5% dividend yield companies with growth is tremendous.
And maybe think of it like I want to be invested in this company regardless of what they do with the dividend?
Well, no. For us, it's no. We're
like
very
a Disney,
strict.
For example,
Disney,
right?
for us,
do you still like it if they don't pay a dividend?
If you cut the dividend, to us, that's it. We're not happy. Because if you have expectations and you're telling us the dividend's going to grow, and then a problem happens, you're not managing capital allocation correctly. Right. You're misallocators of capital. And for us, that's a sin, if you will. It's really bad. We entrust the shareholders, the management, to treat our capital with respect, because we look at it, our firm looks at it as we own a part of a company.
Right.
Yeah.
And if you can't treat our capital well, if we can't trust you with capital allocation, we're gone. So
Very
dividend
punitive.
to us,
I understand.
we're
Max,
gone.
I've got 30 seconds left or I'm going to get in trouble. But if retail investors have been buying just NVIDIA, just the S&P 500 index,
Right.
how do they get started in dividend investing?
Well, it depends on the side. There's a lot of good ETFs out there that pay dividends. We like them, dividend growth. You get a mixture. I would look for companies I understand and investments that pay a dividend. And in every sector, there's a good paying dividend stock. You just have to look. So if you like big tech, look for those who have a dividend policy that you like. We have investments in the Microsofts. We have investments in Alphabet now. We have the Broadcom. Actually, Broadcom, which we own investment, has been a tremendous dividend payer. People just don't realize that. So we say look in those areas that excite you, but look for dividend paying stocks.
Max, really appreciate it.
Thank you
so
so
much for
much.
coming in. We'll have to
Appreciate it.
have you
Thank you.
come back soon. All your
Thank
markets
you.
action ahead here on Yahoo Finance. You're watching Catalyst. A win for crypto. The Senate advancing legislation aimed at regulating stablecoins called the Genius Act. Bitcoin is off of its earlier highs, but still rising on the news. So where does the rally go from here? Joining us now, Noel Aitchison, the author of the newsletter Crypto is Macro Now, and the former managing director of research at CoinDesk. Noel, it's really great to talk with you, and I'm excited to get you to contextualize this for me, for crypto investors. Why is this such a big deal for the industry?
Great to be with you, Madison. Thanks so much for having me. It's a very big deal because it's the first official crypto regulation in the United States of America, which, as you know, hosts the world's largest financial market. If you told us a few years ago we'd be here today, probably would have laughed at you. So it is a very big deal. It's a big deal also, Madison, because it was supposed to be the easy one. This was the low-hanging fruit. A stablecoin is a stablecoin, not too mysterious, right? Well, it turned out to not be so easy after all, and it was really touch and go for a while whether it would pass. Had it not passed the cloture vote, that would have been a big blow for the industry because it would have put a big question mark around all of the other crypto regulatory actions we need.
Yeah, let's talk about those other crypto legislation areas where you still want more regulatory clarity for the industry. What are those corners that still need a little bit of regulatory clarity?
Well, first, we have to get the stablecoin bill passed. What happened yesterday was it passed the cloture vote, which means it now goes to the floor for a full vote. It got good momentum, though, so it's looking positive. But as you know, in politics, anything can go wrong at any time. So we're not out of the woods yet, but it's looking good. The next big hurdle to overcome is going to be the crypto market infrastructure bill. That's a lot more complex because that involves deciding what is and isn't a security, what custody rules are, etc. Everything that would go into helping a resilient and efficient market infrastructure emerge around the crypto asset market. So that's a very big deal. Then after that, the biggest and the hardest will be some framework around DeFi. You can imagine how the regulators are going to be pushing back against some of the provisions that we're hoping for there.
And Noel, my guest host Chris has a question as well.
Yeah, so you see this run up on the expectation of what's about to happen. We've seen this in other markets, other industries in the past, and sometimes it tends to result in what they call, buy the rumors, sell the news. Do you think there's a risk of that this time around?
I don't, Chris. And the reason why is that I think the move we're seeing in Bitcoin doesn't have anything to do with the stablecoin bill. The stablecoin bill and the crypto market infrastructure bill that I was just talking about, they're going to affect pretty much everything else. Not so much Bitcoin because no one really debates that whether Bitcoin is a security or not. And its market infrastructure is already pretty liquid and robust. So Bitcoin has a whole lot of other things going on that have to do with expected monetary and fiscal liquidity. And I think the big run-up we saw on Sunday was to do with Treasury Secretary Scott Bessent's comments that they were going to focus on GDP rather than bringing down the deficit. And there's also the safe haven narrative that is propelling Bitcoin higher as geopolitical tensions escalate and as currency concerns continue to build. The Bitcoin does have a strong safe haven narrative going for it as well.
Noel, I want to switch gears ever so slightly here and talk about the White House's role in all of this with that crypto dinner coming up on Thursday. Investors potentially feeling like there's a pay-for-play opportunity where they can get access to the White House by investing. How does that complicate things for the industry and further questions about a conflict of interest from the president?
It's a very big complication. That is an excellent question. And it is one of the things that scuppered the stablecoin bill. There were many objections to the fact that the bill, as currently drafted, does not prevent Trump from benefiting from his company's stablecoin. It still doesn't contain that provision, the one that actually goes to the floor, but there is it highlights the concern around the fact that there could be some insider, not dealing as much because this is pretty transparent, but insider benefits for regulation being passed here. So it is a concern. Most of us in the crypto industry are very uncomfortable with this because it's just not a good look. I mean, right now, when things are supposed to be going well for the industry, when we're supposed to be getting, the adults in the room, this is not a good look for the industry, as it does highlight the potential for, as you mentioned, trading of influence as well as just meme froth.
Right. And of course, the fact that the president has this meme coin, like you mentioned, is a complication for that adult in the room narrative. Noel, thank you so much. Really appreciate your time.
Thank you.
I want to get final thoughts with my guest host, Chris Versace. Chris, how do you think about crypto in this environment?
I have to be honest with you, I don't. I know that's a sacrilegious thought, but I'm between the fundamental work I do, the thematic work I do, and the portfolio for the street, I have my hands full.
Right.
So do we keep tabs on it, and will we see if it matures, goes mainstream? Then we'll have to think about it a little more, kind of like gold.
Right.
But for now, it's kind of on the periphery for us.
Does it feel like an asset class that is a risk for stocks in any type of substantial way longer term?
As in terms of an alternative, you mean?
Yes, in terms of, I don't know, do you ever see, like, if Bitcoin becomes the new bonds as a flight to safety, do you see?
I don't know about that just yet.
In a century, maybe.
Oh, if it's in a century, it won't be my problem.
That is true. That is true. Chris, really appreciate it. Thank you for making the time for us this morning. I want to do a check of the major averages here as we head to break. You're still looking at losses across those averages. The S&P is off its lows of the session. It's off about 0.2%. Tech still taking it on the chin. The biggest loser in the S&P is on a sector basis this morning. You got your tech-heavy NASDAQ off just about 0.3% here. Of course, the key focus for markets heading into the trading day today is what's going to happen with that tax bill. And maybe we'll get some tariff headlines. We have the president teasing out potential tariff headlines to come from the White House as he spoke with reporters very briefly this morning. Of course, we'll bring you any headlines as we get them. Coming up, we've got Wealth that's dedicated to all of your personal finance needs. Our very own Allie Canal will have you for the next hour. Keep it here.